starting in just a couple minutes. We have the legendary trader Nick joining us next month. He was here about a year ago and offered us really awesome advice in geopolitical and long-term macro fields. So we're going to be talking about that stuff again. So share this around, and hopefully we can get some good long-term investment advice. Mavens, we're back once again. Trader Nick, the legendary Trader Nick, one of the best faces in the industry, one of the most reputable guys that really gives you a realistic approach of how successful you can be in trading world. He's been doing this for a very long time, over a decade now, I think. Hey, Trader Nick, quick introduction of what is your methodology around trading and how do you trade?
Good to be back, Hunter. I mean, we've done content together back and forth throughout most of that time. I think I've created content since like 2019, I want to say, and I've been trading since like 2015, 2016. So it has been just around 10 years, which is crazy. Little bit like the high level overview of me. I'm predominantly a swing trader. I'm a macro trader. I trade commodities, a little bit of currencies. I trade indices quite a bit, and I trade stocks and options. So I really am a junkie. I trade all sorts of different things. I trade options as well. So I kind of go all over the place, but rooted in kind of what I do is first and foremost focused on macro fundamentals. I find them to be an incredibly untapped area within the retail trading space. They're not very popular. They're not very exciting to a lot of people. But it adds so much clarity to understanding why charts are moving. You know, there's a reason we all watch NFP reports, and we watch Jerome Powell and now Kevin Warsh get up to the stand and talk. It's because that stuff moves markets, and that macro is so critical to why charts are going one direction or the other.
Yeah, totally. I'm just gonna ask you a quick question about options in a second here. But if you guys are new here, we have a $50,000 Maven account up for grabs for the best question. So I'm going to be reading questions along the side here, and any question I like, I'm just going to post it up, and somebody's going to win a 50K Maven account. But you said you trade, Forex, gold, options, futures, whatever, right? And now, not many people trade options. What would make you switch from, futures or the CFD space to options?
That's a great question, because with options, there's so many things you can do within options. Like if you were, and for those of you who are not super familiar with options, you can buy puts, you can buy calls, you can also do combination trades. And for a lot of traders, one of the advantages of options is that it is essentially leverage, right? You can buy a lot of shares with a lot less money. That is very attractive to a lot of traders. So buying calls, buying puts, those are huge, draws for people to get into options. For me personally, I like to play market maker with options and be the seller of options. So I'll sell cash secured puts. I'll sell covered calls. I might even trade, short strangle positions. Now, these sound like foreign languages for people who are newer to this stuff. But on the options side, you can essentially sell insurance. You can sell other people the ability to play at the casino, essentially, when you sell options. And it is in no way a holy grail, because you can get into a lot of drawdown with selling options, just like you can with buying options. But I do tend to prefer to be on the sell side of options. So I'll sell someone else a cash secured put or sell someone else a call. That's on that side. Now, why the advantage there? Well, in that case, options are time decay. They are price depreciating assets. They lose value over time, because if I buy a call by the end of the year and 3 months goes by, you now have less time for that option to hit or that bet to hit, right? So they lose value over time. Now, when you're selling something and it loses value over time, that's to your advantage. When you're buying options, the reason I really am not a big fan of buying options is they lose value over time. So let's say I think gold's going to go up in the next 3 months. If I buy a call on GLD, which is an ETF, or if I buy gold futures contracts, or gold options on futures contracts, if the price goes sideways, I still lose money, right? Like I lose to that time decay value, even if gold moves nowhere. So I like to be on the sell side for that reason in terms of that. But I do options on lots of things: stocks, commodities, etc.
Yeah, it's interesting. I've been doing this for just as long as you have, pretty much. And I have never once touched options, because honestly, it's too confusing, right? You have all these different, the irony is so many different options, right? And it makes it rather complicated. So personally, I'd rather just stick to the simple things. But trading is such a weird world where you can do the same thing so many different ways. It's essentially the same sort of, you're betting on if something's going to go higher or lower. Right.
And that, to be fair with options, you actually don't even have to do that. That is another appealing thing about options. Let's say, for example, that I think gold's not going to go very far in the next month. I could actually sell a put and sell a call. So, and in that case, what happens? Well, if the price goes sideways, you just collect a check on both of those things. So what's cool about options is, if you are selling them and buying them at times, if you're creating like combination trades, et cetera, which gets complex very quickly, the beauty of it is that you can actually make money if price goes nowhere, and you don't necessarily have to be so directional. It's not necessarily bullish or bearish. That's so binary. And when you get into options land, you can be like, I'm kind of bullish, or like I'm kind of bearish, or I think it's going to go nowhere, or I think it's going to go really far one way or the other. Like you can do all these different things with options, which is very different than just buy or sell.
Yeah. So essentially, if you're selling an options contract to somebody who wants to, say long or something like, or do a call, right? You make money the longer it does nothing for them, right? So it's the exact inverse, and they lose money over time, or lose potential.
Yeah, and the easiest way I think about it is this. Let's say you have a house and you want to insure your house. You pay the insurance company a premium up front, right?
Yeah.
So you're going to cover it for a year. They're going to protect if your house were to burn down. Like they're going to protect you for 1 year for, let's say, $1,500. You pay them the full $1,500 right up front. That's how much money they're going to make. Maximum, they're going to make $1,500. Maximum casualty for them is they have to insure your house. But most of the time, the house is not going to burn down. It's going to be fine. And they're just going to keep collecting that check from you over and over and over. Nothing's ever going to happen most of the time. and they're going to make money that way. That's how options work. So if you're selling a put, you're selling someone else insurance, essentially, collecting that premium up front and offering to cover their downside.
Oh, interesting. Okay, there's a lot more to it actually, because I've never even bothered looking at it.
Yeah.
Because I've just been happy doing what I was doing.
No need to like change if you have something that works for you. But it is a fascinating world, the options world.
And so a question then on that is, do you have an incredibly high win rate when you sell options?
Yes. And you have options within these options. How far out do you like? Do I want to sell a call that's close, which is obviously a riskier thing to sell someone? Or do I want to buy a call or sell a call or sell a put that is way further out of the money? In which case, very low probability of it getting hit, very high win rate for the seller.
Now I'm wondering, so being a prop firm owner, right? I know, and I tell people this, right? That the way to win on prop firms is to have a very high win rate and go on winning streaks, right? It is more advantageous to go on a winning streak than be a profitable trader, because all you're shooting for is that payout, right? So if you win 10 times in a row and then lose 10 times in a row and you break even overall, right? Well, ultimately you would have made money on the prop firm, but on your personal account, you would have been break even, right?
Yeah.
And James Bruce has just joined us. Sweet. Okay, cool. Hey, James.
What's up, James?
What's up, Nick?
How's it going, man? Good to see you.
Cool. So sorry, I just interrupted myself there by bringing you on there. But so my question then is, there's not really any options prop firms, because I imagine, and maybe you can confirm this for me, it would be incredibly easy to, break the system on an options prop firm just by going on 95% win rate strategies.
Yeah, because it's almost like options. So most people on the retail level are not doing option selling. That is usually, it requires high capital basis.
Okay.
Because again, the appeal to options for like the average trader, and I'm not speaking negatively, it's just that most people don't have $50,000 to insure someone else's stock portfolio, or $100,000, whatever. So they do the opposite. They buy a call, they buy a put, because that's going to cost them $200 for the possibility of that turning into 2,000 or way more than that, right? So that's the appeal to options, is that it offers you leverage. So I don't, again, I'm not the expert on prop land. However, my thought process would be options are leverage essentially. So leverage on top of prop firms, which are also essentially leverage, would be very risky, right? Because for the firm, it's like, if somebody catches a monster rip on the NASDAQ, or a bunch of people are long calls on the NASDAQ, it's like leverage on top of leverage. The payouts would be immense.
Incredible for marketing.
Yeah.
You would have this casino sort of lottery sort of mindset in there if people are selling their options, and then one trader out of 1 million makes $1 million, right?
Sure. Yeah.
Okay. Yeah. So it would be really difficult. That makes a lot of sense, actually. And I imagine there are options firms, I believe. It's not popular, but I imagine they wouldn't allow selling. Right?
That is probably correct. And you know why they wouldn't, Hunter, is because the prop firm game is essentially selling options. The business model itself is kind of doing the same thing, because what you do is you offer to traders, hey, here's a fair chance to make your gains in the market. We're going to sell you for a upfront challenge fee, which is the premium. It's the same concept. It is essentially the idea of selling options to the average trader. And again, there's nothing wrong with buying calls or buying puts if you have strong directional bias, and you can work really great for you. It's not it's not just an instant loss. But I would say that, prop firms, they offer a service. Yes, it is a challenging thing for people to get funded, stay funded, get paid, but it's a doable thing. There are people who do it. So it's like, it is essentially the prop firm world is kind of a business model similar to insurance, similar to option selling.
Totally. Right, let's pivot into something a little bit more understandable for me and maybe some of the viewers, because I am just a dummy, and options might be a little bit over my head. Okay, you recently predicted gold would be selling off, and a lot of people are crazy bullish on gold and metals, and there's a lot of in my mind, I'm like, hey, the the markets are shaky right now. There's war going on. Why is gold selling off, right? Usually when there's a lot of panic, gold does well, but you took the sell side. And personally, I was trying to get in the longs, and I took a little bit of losses on there.
Yeah, no, it's so I want to upfront say that I am also long-term always bullish on gold. Like, I love the idea of keeping some gold exposure. The lower it goes, the better it is in my view, because it gives you a chance to buy gold. Again, not financial advice, but it gives me the chance, what I believe to be better prices long-term on buying gold. In the short term, however, the macro has been really bearish gold, which is confusing because you hear geopolitical stuff going crazy and you think, what are you talking about? How can gold go down in a war breakout? That makes no sense. But the big story is that gold bows down ultimately to interest rates, what the Fed's doing, what central banks around the world are doing. If they're raising rates, it is like the dominant thing. And so all this oil spike stuff caused a big surge in inflation. A big surge in inflation makes all the central bankers say, we got to fight inflation. We can't cut rates. And we go from a story where last year we were getting a bunch of rate cut promises, which was very bullish for gold. Hey, the market's going to see, they're going to slash rates. There's no point in having yielding dollars. They're going to lose their yield, right? Basically, when interest rates go down, dollar becomes less attractive to hold. And so gold was flying. And now it's the exact opposite. You have inflation that's sticky. You have jobs data that's been better than anticipated recently. You have interest rates that are expected to stay high or even go higher. Other central banks, ECB just hiked rates. Bank of England is talking about doing it. And the US Bank is talking about potentially doing it end of year. You have all that circumstance. That is a devastatingly different landscape for gold in the short term. Now, long term, I'm not a precious metals hater. Trust me, I've caught tons of flack for being short gold. Like, so many of the precious metals people are like super pissed at me about this. And I'm like, my brothers and sisters, I am one of you. I'm just short term bearish on gold. It's different than being a perma bear on gold.
It's the same with Bitcoin too, right?
Yeah. Yes.
Yeah.
Sure.
Crypto will probably do well forever, but sometimes you sell, right? Yeah. You exit positions
Nick,
or your risk.
Yeah.
Nick, I got a question for you. Obviously, with you got into the trading space, predominantly known as the swing trader, right? And futures have become quite popular in the last 2 years, give or take, with obviously the futures prop firms and everything like that. But you predominantly swing trading CFDs, correct? Still swing trading on the CFD side of things.
So I don't trade CFDs just because in the US I can't on a regulated brokerage. Now I could if I was trading prop, obviously, like you can still kind of access that product. But I predominantly trade ETFs and or futures if I want to trade gold, if I want to trade NASDAQ, etc.
Is there not one regulated broker in the States that offers CFD trading?
No, so CFDs also carry leverage, and the US is like no CFDs. You can't touch CFDs. So
interesting.
Yeah, they did recently change some laws around day trading requirements for US traders, which was big, but still no CFDs, unfortunately.
Okay, got it. Just interested to see, because obviously the futures have been, the prop firms on future side of things, you can't actually swing trade on them, right, Hunter? That's correct?
Yeah. So I think, and I don't know exactly how all of them are structured and how they work. I know swing trading, like weekend holding, is another question mark for a lot, and all sorts of different things.
Maven allows swing trading because we're trying to promote, good trading habits, right? We have no swap fees on all of our accounts, right? The only firm that does that. And awesome. Most people don't take advantage of that, but, still going to promote it, of course. Okay.
Yeah,
sure.
Cool. I've got a couple questions I logged here that people were asking, but I want to do a personal question here, actually, because, I'm quite bullish on copper, right? And I've been using your Edge Finder program, and I use it a little bit, not so much because I'm more of a day trader, but every once in a while I use it to aid, right? So I used it. I looked at, hey, gold is actually quite bearish fundamentally. So I actually exited some of my longs a little bit early and saved me some money. Great.
Nice.
But I noticed copper is so much more bullish fundamentally than gold. Right. And that's how my personal opinion thinks too, is, hey, copper is going to be a really useful thing. Why is copper different from gold? And where would silver lie?
Yeah, no, that's a great question. I've got my screen shared. If you want to throw it up on there, go for it. I could break that down. So copper is fascinating because gold and silver are referred to as precious metals. I'm sure everyone in the audience has heard that expression before. Precious metals are more of it's an alternative to stocks. It's an alternative to bonds. They're another place that people park money, but people don't necessarily do that with copper, right? Like you're not hearing about like Indian tradition where they all hoard copper, right? Indian tradition, they wear gold. Like gold it's like something about the nature of gold that people just absolutely love. They want to stick it under their mattress and hold on to it for the rest of their life. Not so much with copper. Copper, though, is an industrial metal. If you're building airplanes, if you're building buildings, if you're building wiring, if you're building computers, physical stuff, copper is an incredibly useful metal in that regard. Same, silver is actually kind of this way too, where silver is actually, I think, again, I'm not the expert on this, but I believe silver is more practically used in things even than gold, for like computers and all solar panels and things like that. But copper is interesting because it's not the exact, it carries some similarities in terms of how it is impacted fundamentally, but difference in others. So for example, if we're looking at strong economic growth, I could point to 4 categories here that have been recently stronger than expected for the United States economy. PMIs, which are a forward-looking indicator of the economy, both in services and manufacturing, came in stronger than expected. Retail sales numbers came in stronger than expected. Consumer confidence came in better than expected. I'm not saying the U.S. economy is in incredible shape because it's pretty K-shaped out there, but recent indicators, which is what the market cares about, have been ticking up more than Wall Street forecasts had been expecting. Yeah. Now, that positively impacts copper because copper likes roaring economies. If the economies of the world are doing well, there's going to be more demand for copper and also oil, right? So those two things, like these industrial needs, tend to benefit from stronger economic activity. Not so much for gold, right? If I'm looking at gold, if we're looking at PMIs being better than expected, the retail consumer is actually spending more than expected, consumer confidence is up, jobs have been added more so than expected, that does not help gold because gold does not like a strong dollar and resiliency in the economy. It likes the opposite. It likes when the economy is falling apart, people are losing jobs, the Fed's cutting rates to try and save the day. That's when gold loves, economic data like that. So they're different in that way. Copper benefits from some things that gold does not benefit from, but they share something similar with typical like inflation, et cetera. Like if the Fed is raising rates, et cetera, that kind of tends to just hurt commodities across the board. But they're not perfectly the same, right? Copper, you also pointed out, like you've been trading a lot of copper. Copper's got a much prettier chart right now than gold for that exact reason. Economic prints have been good versus expectations, which are terrible for gold and not so bad for copper. So that logic is kind of holding up right now.
Would you say, just to simplify it, copper follows more of the stock market or gold?
So,
or is it a blend?
It's kind of a blend because gold has like an impressively low correlation to the stock market over long stretches of time. Although sometimes it feels like it moves right there with it. It doesn't always. Sometimes it does. Sometimes it doesn't. The long-term data would generally suggest low correlation between the two, which is why it's a really attractive, in my opinion, longer-term investment as well. Again, not financial advice, because when you look at gold having a low correlation to the S&P 500, but also tends to rise, that's a beautiful thing, right? If you have some money in gold, some money in NASDAQ, et cetera, both tend to rise, but they might not do so at the same time. That's actually nice from a portfolio perspective, because one could be kind of doing bad and the other could be doing well, and vice versa. Or, both can do bad, but they're just generally lower correlation.
Yeah. Okay.
Jeez, I don't think I've ever personally taken a copper trade in my life.
Really?
Yeah, I've recently gotten into it after I saw the other metals popping off and started doing a little bit of investigating. And I think copper is probably going to be a pretty good investment over the next few years. right?
Sure.
I think with all the data center build out stuff that's going on, with all the space talk and stuff like that, I don't hate the idea, especially if you think the economy is going to hold up in the next few years.
Yeah.
I would generally think copper is going to be strong as well.
Sure. Okay, so I have just one more kind of a direction that I want to ask you here. Do you know anything about U.S. Treasury bills?
I love talking bonds. It's
Yeah.
just such a boring topic to most people, but not to me. I love
See,
treasuries.
that's what I want to do is I want to get you on here and we want to talk about the things that other traders don't talk about, right? And I think that's the whole purpose of Trader Nick is he is the outlier that watches the stuff that's actually important. It's nothing to do with hype, right? So what can you tell us first of all? What is the US 10Y that you got on the chart right there?
So I'll give you guys a pitch in the audience. Every single person, I don't care what you trade, if you trade the 1 second chart or the 1 month chart, 2 charts that every single person here should add to their watch list. No questions asked. Doesn't matter what you trade. The first one is going to be the 2-year yield. I guess I have 3 charts. They're hard to pick from. The 2-year yield.
2.
Yeah, okay, only 2. We'll only do 2. The 2-year yield is going to be our first one because the 2-year yield tracks pretty closely what the Fed's going to do. Most of the time, the 2-year yield is pretty dang spot on with what the Fed is going to do. To read this simply, typically speaking, if this thing is rising, the Fed's going to keep rates or move them higher. If this thing is moving lower, the Fed's going to cut rates. Generally expected to cut rates. Okay. This is a predicting constant, the bond market is very smart. They call it the smartest market a lot of ways because it is reflective of monetary policy big time. Yeah. So
long-term stuff.
Yeah, the 2-year yield, if this thing is rising dramatically, Kevin Warsh took the stand the other day and the 2-year yield screamed higher because the Fed, in the eyes of the market, is now looking like, oh, they might actually hike rates. So the 2-year yield moved higher dramatically. The 2-year yield is what you get paid to lend the government your money for a period of 2 years. That's the way I read that. So that changes over time. You get paid more or less to lend your money to the U.S. government and buy a bond. So in the 2-year yield, the way to read that with a 10-year, 20-year, same thing, right? It is how much you get paid is right here in interest per year to hold a bond. It's super boring because you look at this and you're like, wait, 4.18%, that's nothing. Well, you have to remember the bond market is like the biggest in the world. It is ginormous for investment. And so you have all these ginormous firms and funds and pension funds, et cetera, moving money around, and they might park it if it gets to certain levels, et cetera. But anyways, from a trader's perspective, why do I say this is for everybody? If this thing is moving higher, it's telling you the Fed is likely to keep rates elevated or hike rates. That means a lot to people who trade gold. It means a lot to NASDAQ traders, to stock traders, to options traders, because what has been happening, part of the reason I've been bearish on gold is because I've been bullish on yields moving higher because inflation's on the rise. Why does that matter? Well, again, I know we're getting deep in theory right now, but if inflation's on the rise, what does the Fed do in response to that? They take rates higher to try and get this number to chillax, right? So to get inflation to come down, they have to raise rates to combat that. And so when the 2-year yield is rising, that's telling you the market thinks the Fed's going to hike rates to keep them, or at the very least, keep them elevated for a suspended period of time. So
just to button. Also, I've got 2 questions. One, if the Fed's hiking rates, it makes it more expensive for people, the general population to borrow money, right? So then obviously spending will go down. But then also, if rates move higher, is that negative or positive for the stock market?
Yeah, that's a good question. Annoyingly, another low correlation asset is actually the 10-year or bonds to stocks. They tend to not. It's not a perfect correlation. However, most recently, generally speaking, rising rates are negative for stocks.
For the stock, yeah.
because what you said, borrowing costs going up are a direct hit to the bottom line of companies, right? Like if they have to borrow at higher rates, that costs them more over time. So, and also it hits the consumer who wants to buy houses, student loans, credit card debt. Yeah. All these different things become more expensive. So, so this chart is very, very, very important.
It's actually interesting that you bring this up, Hunter. I was on a podcast the other day with Kathy Lynn. I'm sure you know Kathy, Nick, but she was speaking that you need to look at rates in order to get a good gauge for stocks as well. So it's interesting to hear that you say that as well.
Yeah, and again, I know I'm peddling my software here, but the reason we built it in this way is to take this very abstract, difficult concept and to try to display it in a simple way. So rates move off of this stuff. Like this right here is pretty much your rates heat map, because if the dollar is moving higher, usually it's because rates are moving higher. They tend to move together. Not always, and it's not perfect.
And by rates, you mean the bonds.
Yeah, bond interest rates, yields. Typically, like I said, this 2-year yield chart is going to lead what the Fed does. So if the Fed is going to hike rates, there is a very strong probability that rates or yields, the 2-year yield, will have moved first. You will see it in yields before the Fed says it. Okay. So because the bond market
is a little cheat code for the audience there.
Yeah, the bond market is freaking smart.
So they can predict the news releases. Don't news trade, but and so another question. So you have the 2-year and the 10-year. Is the third chart you wanted to say the correlation between the two?
That is an important thing to look at for sure. But no, the other one is the VIX. The VIX is, I'm sure you guys know the VIX, but for a lot of audience members, they may or may not. This is also really important because if you if I could only have 2 charts to look at, it would generally be the VIX and it would be the 2 or 10-year. I'd go back and forth between those.
Interesting.
But the VIX is super useful because it tells you what implied moves. So Hunter, we were talking about options earlier. The VIX is the implied move according to the options market on the S&P 500. So if you take this, here's another cheat code for everyone.
Yeah,
take really this smart number, 19.18, divide it by 16, and that is the average expected move per day for the S&P 500 implied by the options market. So if we were to take that today, let me just do it for fun. Wow. 19.18 divided by 16. It's expecting the stock market to move about 1.2% in either direction today.
Interesting.
That's 1%. Yeah. So then you would probably not. 1% is a pretty decent move on the stock market. You probably wouldn't be selling an option.
Yeah, and that's the thing is this actually, from an options trader's perspective, the higher this goes, Hunter, the more expensive options get. So if you're selling, if you sell options over here, you're going to get paid juicy premium because the market's expected to move a lot. If you're selling options down here, you're going to get paid a lot less. And flip that around for options buyers. If you want to buy options, calls or puts, typically the general thought would be you buy options when volatility is low and you sell options when volatility is high.
Okay, so let's ask a really dumb question. Can you do technical analysis on the VIX?
100% you can. Take a moving average, taking RSI. When the VIX gets to certain levels, a lot of people love to sell VIX over certain levels or buy VIX at certain levels. Longer term moving averages can be useful if you get really far away. Like here's last year, the tariff tantrum stuff. COVID went crazy on the VIX. There's COVID.
Nick, on just something interesting as well, Hunter, that I've also picked up. I do a lot better from my day trades when the VIX is trading above 19, even sometimes 20. And then I lean more into sometimes my swing trading positions when the VIX is trading at a little bit lower prices, just because the day-to-day volatility drops off, right?
Yeah, I love that. And here's the thing, James, to that point, most traders tend to, I've got two cheat codes for you guys. Most traders tend to do well in one VIX environment or the other, but rarely do well in both.
In both. Yeah.
Yeah, because
I agree.
you might be the type of trader that loves a little volatility coming in. If you're someone who trend follows and the market explodes in one direction and you're riding that, it's wonderful. Then there's like people who hate that because they mean revert, right? They buy low, sell high. They don't like that. That sucks because they're like
that's more where I fall. Is
You're getting smoked.
Mid to low, right?
And
the
then
crazy
on this side of
volatile. I don't
things-
like the drawdowns.
Yeah, when you're on the other side of things, this type of environment can be really great for mean reversion traders, back and forth. Charts just doing this for weeks on end, and you're just cashing in. But then trend following tends to really not be as fun when the market's not moving. So, yeah, two different environments.
Nice.
Last little trick on that for your audience. Again, not financial advice. Typically, you have to pick with your strategy when you want to go for prop firm accounts. Different environments might be more or less advantageous to your style of trading in different environments. If you're someone who's like, here's another one, GVZ. I've just got charts galore today. This is gold volatility. So this is specific to gold, GVZ. If you're a gold trader, add this to your watch list, GVZ.
Yeah.
Here's last year. Remember, during December, volatility was explosive in gold, right? If a lot of, just from some of the, I don't know, Hunter, on your side, what it looked like, but from my knowledge of prop firm people that I was speaking to at the time, it was like there was so many people signing up to trade gold on firms in that time because the volatility was so extreme.
And it was basically straight up, and we can say this is that the payouts on gold went up, and that is the reason why all of the prop firms, except for Maven, and that's why we did that gold is always on, just to make fun of the other firms, that they were unable to support their own payouts, so they had to turn off the profitable asset because everyone was making so much money on gold that they had to stop trading. And so something, I don't know if you use this, Nick, but a guide that I've kind of more or less looked at with the VIX or the gold VIX is right around 30 is a good buying opportunity usually, because that usually means that there is a massive impulse move in either direction for the stock market or gold. And usually people are saying, hey, this is now a discount, right?
Yeah, let's do some VIX studies. I'll show you something cool.
VIX study, right? VIX 101.
Here's your VIX school. So this is for the S&P 500. Wow. We've done some scenario back tests specific to the VIX for how markets tend to report 1 day, 1 week, 1 month, 6 months, and 12 months out. So if you have a VIX spiking 10% or more in 1 day to the upside, it typically returns positively over the next 12 months. What's most meaningful is exactly what you just said, Hunter. When the VIX closes above 30, look at the forward-looking returns. They tend to be very strong. Now, that doesn't guarantee anything, and the next one could be an explosive down market that keeps going for 3 years. But generally, there's your number, as you just said. That.
So let's just caveat this and say VIX does not care about the direction if it's up or down. So this is calculating also up.
So this is saying if the VIX moves above 30. If we go back to our VIX chart, so let's put a line on the screen just so we can see it. Horizontal VIX. So during any time, historically speaking, on a day that we closed above 30 on the VIX, the average 12-month later return for the S&P 500 was about 15%.
Yeah. So the interesting thing to me is 50% of the time, that move that caused the VIX to go to 30 is going to be an upward move.
It's going to tip. So the VIX is going to move higher, but the stock market's going to be dropping like crazy.
Potentially, unless it's something like we see them. I guess it's super rare that this happens without a crash first, right? Like Micron, for example. If there was a VIX on Micron, that volatility index would be 100, right?
Yeah.
But you would expect that the market would collapse at some point and you wouldn't make profit buying it. But I'm kind of answering my own question here is for the market to pump so aggressively, it should have probably dumped first already.
Yes. So you're definitely right. And there is, by the way, a VIX for Micron. It's called implied volatility. So for every stock it has in the options market,
Yeah.
you can go to the option chain and see what the implied move for that specific stock. And to your point, yes, the VIX can go up on an up move, but almost never in the stock market. So
Yeah.
in like at a broad level, typically you get VIX shooting up like this
When there's a
only
crash.
when the stock market's crashing. But
or,
on an
or a rally
individual,
off of a crash.
right. Well, actually, even when people like tend to freak out when the stock market's going down, and they tend to relax when it starts going back up. So the VIX typically, they call it the fear index for that reason. But when you get Micron moving like this, implied moves are also going up. So, it's a bit confusing at a certain point, but the basic idea is that when the chart's moving way, like think of a Bollinger Band, when the things are expanding dramatically, that's just more volatility being implied in the move. So yes, but generally speaking, the VIX spiking up almost always past 30, that's going to be due to the stock market itself falling down hard.
Okay. There's an interesting question right here, actually. If you could only track one thing on the Edge Finder, what would it be?
So if I could only track one thing, if I could only use one tab, is it?
Yeah, I mean, which feature would be the most important thing to look at for basically what is the most important things? Let's maybe not pick one. Let's pick three things. What are the three most important things for a newer trader that wants to start learning macroeconomics that they should be following?
So, okay. I love macro fundamentals, but I also hate how complex and how unapproachable they are to the average trader. Nobody talks about them because they sound like a foreign language when you talk about them. It sounds like you're just trying to sound smart. But I'm just a nerd about this stuff. And after going through it and learning as much as I have, I still have so much to learn. Like the markets take what you think you know about the markets, myself included, every single person. There's way, way more. It is so deep. It is such a deep library. You're like on the first floor. There's like 100 floors in the library of trading. That's how complex and deep markets actually go. Do you need to go to every floor to be profitable? No, but just know that it's there. So when we're talking about macro, I have a decent understanding of macro fundamentals, but it depends on who you're asking. If I'm talking to smarter people than I'll sound like a dummy. If I'm talking to somebody who doesn't use them, I'll sound like genius. But it's very, very relative. Anyways, if I could use one chart, it would be the asset scorecard, because this one sort of accomplishes everything. I wouldn't even need two other charts if I'm trying to keep it simple. Select your favorite thing. So let's say we're looking at gold. And what this thing does is it ranks and files. This is how the overall scorecard gets generated within Edge Finder. The Edge Finder score here comes from looking at technicals, COT and sentiment, and fundamentals, and it automatically goes through each of those things, all kind of mapped out here, and explains how it's reaching the score that it's getting. So if I wanted to look, go ahead.
And let's dive this even deeper. Let's say they don't have Edge Finder, for example. Which of these three, let's say, okay, so asset scores are the most important thing. The news, press releases, the data, right? That's what's important. Which are the most important things? Like, let's say I'm just a brand new trader. I don't even understand what inflation is, but I want to follow something that's going to give me more or less a good guide without me being confused.
So I would say, let me think about this. I don't know that there's I think that if you want to approach macro, a really important thing is that you have to accept that it's going to take some time to learn. Everyone goes to school for 4 years to get an engineering degree. There's no way like somebody's going to be able to, and I know there's lots of people who love to just be like, oh yeah, Gemini or ChatGPT can just give me a summary. No, it can't. It can, but it can't. You do need to understand what you're looking at, and you need to understand what it's actually going on in order to make comprehensive decisions. Just like you can't ask ChatGPT to just make you a profitable trader. You can't ask ChatGPT to do the macro for you. You kind of have to understand what you're looking at and why it matters. But generally speaking, the fundamental score being higher, and these three categories right here, this summarizes how inflation is impacting this chart, how economic growth is impacting this chart, how the jobs market is impacting this chart. Other things that might be useful is to get a basic understanding of crowd sentiment, right? So if I go retail sentiment and I understand, this one's really easy for people to pick up really quickly.
Yeah.
If you're looking at the New Zealand dollar versus the US dollar, understand that if everyone is on the long side, be careful about chasing longs yourself.
Yeah, it
right?
can't go much longer because everyone's already long.
Right. You've got like very piled in positioning on one side.
Yeah.
If you want to get into commitment of traders data, again,
most people are short on the NASDAQ right now, actually, which is interesting. And
yeah. Yeah. So you have, and if we pick another one, if we go put call ratio, this is my favorite options tool for studying volatility. So when we select S&P 500, when this thing goes low, that means call volume is on a standard deviation basis high right now. And when this goes low, it's put volume is high right now. Now I wanted to read this out to you because look at this. Call volume went off the charts yesterday. What happened the following day?
We came down.
Right. So interestingly, this crowd sentiment right here in the put call ratio can be super useful. So crowd sentiment went really bullish right in time for the market to crush all of those calls. Yeah.
Interesting.
Yeah.
Nick, I've got a
go on,
sorry,
James.
Hans, I've got a you actually made a good point there, and I actually saved it to send to people that asked me that they want to get into trading. So this is the screenshot. I don't know. I think I copied it from your X or Twitter or something, wherever it was. But you said, my honest answer is that learning to trade profitably is about the same difficulty as getting a 4-year engineering degree. It's not easy, and I would discourage anyone from doing it unless you have a very considerable passion for financial markets and economics. And I think that's exactly what you just said now. Like, these are the stuff that you actually have to do to put in the work to actually make money long term.
100%.
It's interesting. What Trader Nick said is he basically, I asked a very dumb question. What is the best thing to look at? And he gave me the exact answer that I would have given somebody if they asked me on stream and they said, "Hey, would buy or short, or like it would be a really like, is it better? Which time frame is best?" That's a question I get a lot. And it's like, it depends on what you're looking at. It's always different every single day. And Nick gave me the very exact same answer that I give out to newer traders as well, is, there is no right way, right? There are things that you accumulate all the data, and you have to know everything in order to be the best trader, right? And at what threshold you become profitable is, kind of up to determination. But
it's like when somebody asks you, "Hey, what's the easiest chart to trade for a beginner?" It's like, bro, you let me know when you find the beginner chart, because I'm going to be hitting that one all the time.
The one simple thing that makes you money. If you could only do one thing that made money, what would it be?
Right.
Probably flipping burgers.
Yeah. Well, and James, one thing to add to your context there, about that thing I talked about, like, so I went to school for computer science, and I would say adding on to that 4-year degree program, it is about the same level of difficulty in my personal experience, having done both, to get a software engineering degree and to become a profitable trader. However, to make more money in trading is 10x harder than getting a computer science degree. Because again, trading is ridiculously hard. You have to have capital, you have to have experience, you have to like build the discipline for it. I would say that it depends if you're comparing, like, reaching profitability, about the same level of difficulty. Making more money from trading than comp sci, like way harder.
Nick, what's funny, we actually share that background. We both went to computer science school, and I would probably also agree with that. And the thing is, with the computer science, you progress through your code, right? You break things down, and eventually you will finish. But with trading, you don't eventually finish.
That's so true.
Right.
You actually, like,
there's no finish line.
Trading, you can be doing really well. Guys, I spoke to a guy this week. This bummed me out because, like, I hate hearing these stories, but also I think it's good to share with everyone here. I talked to somebody recently who said that over the last 3 or 4 years, they had been making bank trading gold, done really, really well for themselves, had fully started to believe they were profitable trader, everything was going well. And so again, this breaks my heart because this story sucks. But they lost everything in this year because of the change in nature in gold. And again, we all can see what's on the screen right now. It's hard to mess this up on the long side. Like during this period of time, if you were long gold, it's like shooting fish in a barrel. Like it was hard to mess that up unless you were leveraging like crazy or something. Like people, of course, still did that. But I'm saying like if you were low leverage, just slow and steady, you just made easy money on gold.
Most days you would have won.
Yeah.
If you were long bias most of the time.
And so then, and I bring that up because again, to your point about finite of like computer science, trading can look finite for multiple years. This is why this thing is such a beast to become a profitable trader. You can look good for a couple years, and then a change in environment can humble the heck out of you.
So on that note, kind of like one last sort of question here. The NASDAQ, the AI stuff, do you think that they will follow a similar suit to what gold did, in that there will be a sort of a collapse like that, a rally up? Do you think this is a bubble?
I do think it's a bubble. I think it's 100% a bubble. That doesn't mean I think it's going to crash tomorrow, though. I think that the people that I've heard explained it really well is like, you can acknowledge something is a bubble. Like the amount of these, I've heard you, Hunter, talk about it on your social media. We talk about SpaceX, when you talk about OpenAI. These things are not profitable. They're highly speculative investments, and they are driving. I mean, all the Mag 7, if you take a look at MAGS, it's an ETF that tracks the Magnificent 7 stocks. They're doing not so great here. And their free cash flows, the available cash after all their business, have a lot of these gone negative. These things were free cash flow monsters for years on years. That's why everyone loved the Magnificent 7 stocks, is because they just minted free cash flow for investors. That has changed because they're pouring everything into data centers and AI and so they're just spending all of their free cash flow into investment in AI.
Yeah, so they're not profitable right now. They're just spending everything.
They're essentially just taking all of that excess cash and just dumping it back into the business. But it's still speculative, because while I do think AI is revolutionary, the technology is incredible. I want to be careful, because I'm not saying like, oh, I think it's going to crash tomorrow. But I think that it is a bubble. I don't know how inflated it is or when it pops, and I won't short it. But I generally think you have to be careful with the really high speculative, unprofitable stuff. Because when conditions change, again, it's like the same thing with gold. Like you just said, when conditions change, you probably will have some blow off top that, doesn't get retested for multiple years.
Yeah. And that's the scary thing, is investing at the top and then having to wait for multiple years. If it's kind of your source of income, right?
If you're looking at semiconductors, for example, I think, again, I know I'm talking a lot about doomsday horror story examples, but I think it's important that people know their history so they don't repeat it. Semiconductors from 2000 until 2017, same thing that is so hype and so exciting today was very exciting in 2000 and 2001 with all the internet craze. It took you, what is that?
17
years to get back to break even, and you watched your 9 years later go to 85% down.
It's an entire age of raising a child, right? You would not be able to rely on that income if you had a child, and you're like, I'll just put it, and then, you know what I mean? Have a child, invest the money, live off that. You would not do well.
Yes. And if you were living off of it, then this drawdown would be more extreme, because you'd be taking money out of it. And this doesn't even account for inflation. So the whole time inflation over 18 years or whatever.
Well, James, do you have any last questions?
No, I think that was, I even wrote down some things. So I hope the guys were taking down some notes there. Very informative. Yeah.
Nick might be, at least of the influencer space, one of the most knowledgeable guys that I have the pleasure to be able to chat with. So guys, hopefully you learned a lot. I'm definitely going to try to get Trader Nick back on in like 6 months or something. If you're game like every 6 months or something, we'll get you here.
Always, man. It's always good to talk to you guys, and thank you for the compliments. I enjoy both of you guys' content too, and I watch it regularly. So for the audience, make sure wherever you are watching, subscribe, check it all out. James, Hunter, myself, again, this stuff is in a sea of a lot of like fake people and a lot of fake stuff. I think it's important to spread the truth and try and be real about it.
Yeah, totally. Okay, thanks so much, Trader Nick. Guys, the winner of the 50K account is going to be posted in the Discord. Yeah, you can find Trader Nick simply by searching him. He's pretty big, Trader Nick. He's on Instagram, X, and YouTube. All right.
Thanks,
take care, guys.
See ya.
Yes, sir.